Hello, sir. Yes, we can see the screen.
Okay, okay, thank you very much.
Sir, I cannot hear your voice, sir.
Hello, can you hear me now?
Yes. Hi, sir.
Yeah, someone muted us all. Anyway, okay, let me start again. We
Okay.
are talk. Can you hear me now? Can all of you
Can,
hear
sir.
me?
Yes. Can.
Okay, okay. So let's do it again. Central Bank of Brunei, or BDCB, Brunei Darussalam Central Bank. As you know, they have recently changed their name from Monetary Authority Brunei to BDCB. So, based on our discussion in the previous class, we are having a look at Brunei Darussalam monetary policy, which is also partly institute the currency management. In Brunei Darussalam, the currency management is through currency board arrangement. Currency board arrangement, if you remember, based on our discussion, is where the currency reserve is the one that will, foreign currency reserve is the one that will help you maintain your coins and notes. So in Brunei, according to the July 2019 data, Brunei has a total of 1182.79 million worth of Brunei notes and coins in the market in circulation. So if you remember, we discussed about it. This is the liability side. This is the money that is in circulation. So in order to circulate money, you need to have equal amount of foreign reserve. So the amount of foreign reserve is 1182.79 million, exactly the same in foreign currency reserve. If Brunei has other reserve, that will not be 100% currency board arrangement. In order to be currency board arrangement, Brunei has to have similar amount of foreign currency reserve. So, for example, there could be dollarization or other methods, but Brunei follows currency board arrangement. And the arrangement with Singapore dollar and Brunei dollar is interchangeability arrangement, where Brunei dollar is pledged to Singapore dollar with a par value or equal value. This is at par and without any charge, meaning that both the currencies will be interchangeable. But this interchangeability comes at a customary tender in respective countries. For example, the Singapore dollar in Brunei would be a customary tender. So Brunei Darussalam, you can read this part. Brunei dollar is a legal tender, while Singapore dollar is a customary tender. And opposite to that in Singapore, Singapore dollar is a legal tender and Brunei dollar is a customary tender. The difference between legal tender and customary tender is that legal tender is a must for that country. So in Brunei, no one can say that I will not accept Brunei dollar. So Brunei dollar is a legal tender in Brunei. But in Singapore, it's a customary tender, meaning that if someone say that I don't want to accept Brunei dollar for payment, they can do it. You cannot force anyone to take Brunei dollar. So it's a customary tender in Singapore, but Singapore dollar is a legal tender in Singapore and it's a customary tender in Brunei Darussalam. So even though it says that it's a unique arrangement, it's not a unique arrangement. There are a lot of countries that follow this kind of arrangement. So that's what I wanted to show. So it's a currency board management where Brunei dollar is pledged to Singapore dollar at par and backed up 100% with foreign reserve. So foreign currency reserve, according to foreign currency board management, foreign currency reserve is the one that keeps the reserve of your currency. And there is a currency interchangeability agreement with Singapore dollar, meaning that both the countries' currencies will be interchangeable at par at 100% value in respective countries. Okay. I did not directly find the balance of payment information in Brunei Central Bank data, but from Economic Planning Unit, I think, and Statistics Department, they have the balance of payment data, which I have downloaded, but the latest data available, I think, is until 2019. So it's quite old. Later, I will upload this data for you to look at, but I think we can just go through the items in Brunei just to get some idea of the balance of payment in Brunei. So in balance of payment in terms of BND $1 million, this is in $1 million. What are the items they count inside from 2015 until 2019? I think 2019 data is also forecasted data. So they have goods and services. First is good and good export and good imports. So if they have good export, they will have revenue coming in. And if they have good import, they will have to pay. So generally the amount that is connecting to the good side is basically the difference between the export and the import, or you can call it the net goods amount. So net goods amounts are, for example, 3977.6. So it's around $3 billion of net good export in 2015. In terms of services, Brunei purchases much more compared to the receipt. So around $894 million worth of service receipt in 2015, which has actually went down further and in 2019 is a little bit higher. What about payment service payment for services? 2278, almost $2 billion, which is now increased to almost 2.4 or $2.5 billion. So that's a deficit. You can see it's a deficit in the service sector, meaning that Brunei is basically paying out for purchasing services from other countries. Possibly it is Korea, it is Japan, it's Singapore, and other countries. Primary income, these are other income areas that are being added apart from export and import. And in primary income, there might be other cases of receipt and payments. So I am not exactly sure because I have not seen this primary income in any other BOP. So this must be related to tourism or possibly other areas. And then comes the secondary income. I again do not know what is secondary income because in balance of payment, I have never seen a secondary income or primary income. So this must be related to some kind of investment done in that year. So all the short term within 1 year income and expenses from goods and services and export and import will be listed in current account. And there are other tables for you to consider. The balance of payment, now you see they are summarizing based on current account and financial account. And in financial account, they have a positive value of $6 billion, meaning that Brunei is doing a lot of foreign investment in financial sector outside. So they do not have any direct investment. Direct investment is FDI, foreign direct investment. Brunei doesn't have any foreign direct investment done outside. They have direct investment in Brunei, meaning that there are direct investment coming in 2015 positive, in 2016 negative, and in 2019 it's positive. Almost $500 million of Brunei foreign direct investment. Portfolio investment is investment in financial asset. Portfolio investment in asset, portfolio investment liabilities. Liabilities means payment of portfolio investment. So no, there is no financial market in Brunei, so nobody is investing in Brunei market. Therefore, Brunei doesn't have to pay anything in terms of portfolio investment. So if you do not have to pay anything, you do not have any liability. Your portfolio investment liability is zero. But in terms of Brunei investment, portfolio investment outside, Brunei has increased and decreased. So 442 plus, 862 plus, then 88.4, 1941, 1907. So let me explain these two figures. For example, portfolio investment in 2018 is 1941.6, meaning that from outside investment, Brunei's loss in 2018 was 1941, meaning that 1.9, almost $2 billion of loss in 2018. And in 2019, Brunei gained almost the same amount, $2 billion of gain in 2019. So the positive figures are receipt, negative figures are payments. Other investment in assets, other investment liabilities. Liabilities means payment. So Brunei receiving from other liabilities in 2019, possibly they are minimizing some liabilities. So there are positive figures both in asset investment and also liabilities investment. Altogether, the Brunei reserve money in 2015, reserve money was negative, $42.4 million, which has kept swinging up and down. And in 2019, it's $1 billion of reserve money. Now, reserve asset is the one that will eventually be considered to represent the strength of your economy. In any case, this information is not that updated. It's until 2019, which is not even complete. 2019 information, I think, is not complete. The notes are also not given carefully, so it's not very clear to this respect. But I will upload this data later on. Since it is public information, we can share it. I will upload it on Canvas for you to have a look at it. Now let's come back to our discussion. Now you know at least briefly what are the amount related to balance of payment. Let me take you through this one more time. In balance of payment, there are two major accounts. One is the current account, the other one is capital account. Capital account nowadays they call it financial account to make it a little bit specific. Current account is short term within 1 year, and the capital and the financial accounts are long term in nature. In current account, you have generally current account balance is generally based on goods and services. So export of goods and import of goods, and then export of or credit of services and debit or import of services. So whatever you are receiving, these are considered as your credit, and those you are paying considered as your debit or minus figure. And from these all short-term activities, export and import, there will be a balance. That balance we call current account balance. Now, in a brief, if current account balance is positive, meaning that this country has higher export than import. If your current account balance is negative, meaning that you have more import payment than export receipt. Let's move on to the financial account. In financial account, your foreign direct investment. Once again, if your foreign direct investment is positive, you are receiving more than paying. But if you have more foreign direct investment outside, meaning that you are investing more outside, therefore you are creating liabilities. You may also earn from your foreign direct investment outside, so you can add them as your income. Portfolio investment is investment in financial asset. You can have portfolio investment coming into your country or portfolio investment done by you outside. So both can earn revenue for you, and both can be also create liabilities for you. So based on your financial accounts, you can also have a net balance, financial account balance. If the net financial account balance is positive, meaning that you are receiving more from financial investment. If your financial account balance is negative, meaning that you are paying more on your financial investment. And at the end of all calculation, you will do a net change of all activities. That is basically how much is the total in terms of the current account and how much is the total in terms of financial account. And this must be closely matching with each other. This must closely match with each other, therefore creating a balance of payment. If there is no balance, meaning that these two figures are not matching with each other, and the difference between the output, sorry, not the difference, the output of all this transaction that you do should be reflected into foreign currency reserve, the output of everything that you do. For example, if you receive more from export, then your foreign currency reserve should be strong. Okay, if you receive from export, if you are exporting to, for example, Philippines, then you are receiving foreign currency from Philippines, which will be converted to Brunei dollar, or it will be kept in Philippine peso in your currency board, meaning that your current foreign currency reserve will be strong. If you are receiving from Japan, for example, you receive in Japanese yen, and because of receiving from Japanese yen, your foreign currency reserve will be strong. But if you are paying, let's say import, you have imported from Australia. So when you are paying to Australians, you are basically paying in terms of Australian dollar. So your foreign currency reserve in Australian dollar will be lower. So you can also guess from these trading activities which currency should be dominating your currency board when you are keeping things in your currency reserve. Which are the currencies you believe that would be stronger in your currency board? Basically, the currency board, the currencies that you have in your currency board or your reserve will be determined based on your trading partners, because the reserve that we keep is generally used to pay for trading activities. So if your main trading partners are Singapore, then Japan, and then South Korea, Australia. If these are your major trading partners, you will be keeping these currencies more often in your currency reserve so that you can use these currencies, foreign currencies, to pay for export and import. So from balance of payment account, let's now look into how balance of payment is connected to other important figures. What is the connection between balance of payment and GDP, gross domestic product? Now, GDP is the total amount of productions in a country in a specific year, and that counts in terms of 4 factors. GDP is a function of the consumer spending plus the investment in terms of long-term investment or capital investment, we call it, plus the government expenditure, total government expenditure, plus export, the export revenue, total export sent to other countries, minus import. Import is the import payment that you have to make to other countries. Now, if you look at carefully, at least 2 items here, these export and import, these 2 items directly coming from balance of payment. These 2 items, if you remember, we call them current account balance, right? So export minus import, these come into current account balance. So what is the relationship between BOP and GDP? Is a direct relationship. If your current account balance is positive, meaning that your export is higher than your import, then your GDP will increase, right? So your GDP has a direct connection with balance of payment. But if your import is larger, if you are paying too much of money outside, if your import is large, then your GDP will drop too, because you have to make more payments, and whatever you produce locally, a good amount of money will be used to produce for your import that is coming from outside. So there is a direct connection between BOP and GDP. Next one is, what is the relationship between balance of payment and exchange rate? It's very important for us. So take it carefully. Balance of payment, it can be a function of these factors. What are these factors? Export minus import is the current account balance. Capital account balance is capital input minus capital output, or capital inflow minus capital outflow. Financial account balance is financial inflow minus financial outflow, meaning that all inflows are received and all outflows are payment. And then you have plus or minus the foreign currency reserve. Foreign currency reserve actually work as a balance between all other factors. So if you have too much of inflow and export, your foreign currency reserve would be stronger. That will increase your BOP. Or if you want to balance your BOP, then you will reduce foreign currency reserve, or you will control foreign currency reserve in order to maintain your balance of payment. Now, what is the relationship between exchange rate and balance of payment? The relationship is very, very clear. Account balance is directly affected by foreign currency reserve or foreign currency rate, because your export is connected to foreign currency rate. If you are exporting to Japan, your foreign currency relationship between Brunei dollar and Japanese yen will influence your balance of payment. If you are importing from South Korea, the currency of South Korea and the Brunei dollar will eventually determine what should be your current account balance. Financial account, your financial investment in other countries, the currency relationship with that currency or country will determine what should be the received inflow and outflow from financial account balance. Also, foreign currency reserve, which currency you are reserving at what amount will eventually determine what should be your balance of payment. Therefore, at least 3 major factors: export and import or current account balance. Second is the financial account investment in other countries or others' investment in your country, and foreign currency reserve. These 3 major factors would influence the relationship between balance of payment and exchange rate. So once again, when you do export, you need to use exchange rate, which will influence BOP. When you are importing from other countries, you have to pay to other foreign sellers. And when somebody is selling to your country, you have to pay using foreign currency, which will influence the relationship between BOP and exchange rate. Financial account, when you are investing in Singapore, in Malaysia, Thailand, Indonesia, or other countries, your investment will be out from your country in foreign currency, and when you receive something, it will come as foreign currency. So exchange rate, foreign currency exchange rate, is very strongly connected to BOP and exchange rate of each others. Okay, so next is the foreign currency, sorry, BOP and interest rate. What is the relationship between BOP and interest rate? Let me take you to the previous slide and explain. BOP and interest rate. Interest rate is on bank interest rate, or let's say financial market interest rate. I think you know. Sorry. You know. Hello. 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 Can you hear me? Is there any problem? Anyone?
Okay, sir.
Okay. Okay.
Yes, sir.
Okay, so let's consider the relationship between balance of payment and interest rate. Now let's look into the equation again. Balance of payment is determined based on, sorry, balance of payment is determined based, oh, what color is this? Balance of payment is determined based on this equation. So once again, current account balance, which is the difference between export and import, and goes to the capital account and then financial account. So even though not directly, there will be some relationship. If we have time in the future classes, I'll show you. There'll be some relationship between interest rate and current account balance in terms of using derivative market. When you use the money market, derivative market, in one of the chapter, I will explain how money market is involved. So when you are having export and import relationship with other countries, if you want to secure, if you want to pay less, if you want to reduce the volatility of payment, you may need to involve the commercial bank. You may need to take a loan from other countries in order to pay for your export and import. If you do that, if loan is connected, then current account balance through derivative market will be connected to exchange rate and BOP. So current account balance will be connected to interest rate because of use of banks into the channel. Okay, because of using loans into the channel. So it will be also connected to BOP, right? Second is more direct relationship is through financial account. When we are using financial channel or investing in other countries, obviously our return will be determined based on what is the return we earn from that financial investment. Returns are generally determined based on interest that you receive. Therefore, financial investments, inflows and outflows will directly establish a relationship between balance of payment and interest rate. So this is the direct measure. Financial account is the direct measure of relationship between BOP and interest rate. However, there might be also indirect relationship between current account balance and interest rate because of the use of derivative market. So that is the BOP and interest rate. You can read them. There are examples here how financial account or investment in financial sector may influence the inflow on the financial account may connect between balance of payment and interest rate. What are the relationship between trade balances and exchange rate? We already discussed about it, but let me take you through this again. What is the relationship between trade balance? Trade balance means the difference between export and import. So X minus M, export and import, and the relationship between these export and import with exchange rate. What is the relationship between trade balance and exchange rate? So let me take you through this again. Let me take you to the current account balance. It will be easy for you to understand. In current account balance, what are the items that we have? If I zoom a little bit, we have goods export FOB. FOB is free on board, so it is measured based on the export and import to the port of entry. Goods import. and the balance on goods is the calculation of difference between both. So when you do these export and import, these export and imports are measured in terms of foreign currency. So any trade balance is generally goods and services, export and import. So all exports of goods and services minus all import of goods and services. And these are eventually measured based on foreign currency. Say, for example, if you have export to Singapore, Singapore will not pay you in Brunei dollar. There is a unique case though. Unique case is Singapore can actually pay you in Brunei dollar because it's a customary tender. So in order to reduce the volatility between Singapore dollar and Brunei dollar, Singapore can actually pay you in Brunei dollar. But let's say another country, Australian dollar and Brunei dollar. If you have export to Australian dollar, Australia will pay you in Australian dollar. They will not pay you in Brunei dollar. So when you receive Australian dollar for your export, you will have to convert it to Brunei dollar for use in the local currency. This conversion from one currency to another currency will influence the relationship between both the currency. So export and import activities, trading activities, or trade deficit or trade surplus will eventually influence the relationship between two currency. Now, for example, consistently, if your export activities to certain currency is higher. For example, for last 10 years, Brunei has a positive balance with Australian dollar in terms of export. If this happens consistently, Brunei dollar is strong, meaning that Brunei has higher trade surplus with Australia, meaning that Brunei is paying less, Brunei is receiving more. If you receive more, your currency is generally going to be stronger against the other currency. That is generally the case. But in order to receive more, there are other politics that we play. In order to receive more, we generally depreciate our currency. So, for example, let me give you a very brief example. Let's say this year you have exported to Australia, and you are expecting, Australian dollar AUD, for example. You are expecting this $200 million worth of Australian dollar to be received by Brunei for export. Now, if the currency value for the Australian dollar and to Brunei dollar is, for example, 1, just to give you an example. So if the Brunei dollar 1 equals Australian dollar 1, sorry, if the currency value is Brunei dollar 1 equals Australian dollar 1, what will happen is, if Australia pays you $200 million, you will receive exactly $200 million in Brunei dollar. Okay, but if you depreciate your currency, if you make Australian dollar strong, so what will happen? 1 Australian dollar equals Brunei dollar, let's say 1.5. Okay, if you do this, meaning that you need 1.5 Brunei dollar to get the same Australian dollar. By doing that, you are basically making Brunei dollar weaker. You are depreciating your currency. If you depreciate your currency, then you will receive more, right? So what you will do now, when you convert this $200 million Australian dollar, you will multiply with 1.5 instead of 1. So you are going to receive more in local currency. When you convert it to local currency, you are going to receive more if your currency is depreciated and you are exporting. But if you are importing, this will also hurt your import. If you are import-based country, if you have to import a lot of things from Australia, for example, because of depreciation of your currency, you will have to pay more. Okay, because your currency will be weaker, you need to use more of your currency to get less of foreign currency. So in order to get the same Australian $200 million, you have to spend 1.5 times, which is larger than 1 time, right? So that's how currency exchange rate, appreciation and depreciation of currency exchange rate will eventually determine the trade relationship between countries. That is why, many countries, when they trade with China, they are very careful, because Chinese currency has not changed in value for many, many years. They have fixed it. Therefore, in one side, it is boosting China's trade, but the other side, it's losing for other countries. Those are trading with China. Hello, can you hear me? Can anyone confirm?
Yes. Yes, sir.
Okay. Okay, sorry. Internet issue. So today I'm actually in the university. I have a meeting. So university, when they closed 2 months ago, they closed everything. They closed all the internet channels and everything. So I'm basically running on my dongle. What do you call it? The DST dongle, which is not very good in terms of quality. So it just died. So I'm now running on my phone. Hopefully I have the phone charger. Hopefully it will go okay. Okay, so that's what we are trying to say. The overall idea is balance of payment is a strong determinant of economic activities. As you can now see that whatever happening in the economy, whatever happening in your country, if you look at balance of payment, you will be able to know what is your export, what is the import, how much is your service export, how much is your service import, and all other things. Let me see whether there's any other thing remaining. There's only one thing is the relationship between trade balance and exchange rate over the years follows a J curve. J curve is a famous thing. We sometime discuss about it. So over the time period, what happens is the relationship between exchange rate and trade balance is over the time period. Trade balance between two countries generally goes up, given that the assumption of J curve is fulfilled. I think the introduction of J curve got a Nobel Prize, so sometime we emphasize on that. The problem is we stopped discussing J curve. Many textbook does not even include it because the assumption behind J curve, including exchange rate pass through and others, we'll discuss about pass through. So all these requirements do not hold because it's kind of like an efficient market thing. If the market is efficient, if the trading partners are behaving properly, if there is no volatility in exchange market, if there are always positive uh, trade balance, meaning that you always maintain higher export, lower import, then the J curve over the years works between two countries. But if these assumptions do not hold, then your J curve actually doesn't hold. So, we put less emphasis these days on J curve. So until now, what we try to see is that any country's economic activity would be reflected in the balance of payment. Looking at the balance of payment, we would be able to know what is the total amount of export and import, service import and export, foreign direct investment, foreign portfolio investment, everything you will know in balance of payment. And if there is any problem in data with balance of payment, you will also know that the country possibly is doing something that the country doesn't want to tell you. So there are issues with balance of payment, exchange rate, and other matters. Also, to summarize, uh, your balance of payment activity will eventually be reflected into your foreign currency reserve, as you now understand that whatever activity you do with any other foreign country or currency will eventually be coming back to your foreign currency reserve. So if you do more export, if you do more export of services, you will earn more and more foreign currency reserve. Your currency reserve will be strong, which will eventually influence your currency value. But if you have opposite, if you have more import, you are paying more to other countries, your currency reserve will be lesser and lesser, and eventually you will be in trouble. You won't be able to pay for your import. Your payment capacity will be lower. Therefore, your currency will lose value. We have also discussed about currency reserve of China. As you can see, China almost reached $3 trillion, which is quite strong because of their twin surplus. What is the twin surplus? China is the only country that has both current account balance and financial account balance positive, which is quite rare compared to other countries. Generally, other countries will have a balance of current account and financial account. So if your current account balance is high, your financial account balance will be low. But for China, both are positive. Among the other thing we have discussed, if I take you back to the initial stage, if you remember, these are the 6 factors we have discussed that shape our operation in international markets. And we have also discussed very briefly about other factors. We will continue discussing this in other chapters. We quickly move to the chapter 2 because we have actually very limited time and our test is also coming. So we need to finish some important topics before we move to the test and the finishing of the semester. Let me take you to the next chapter, which would be Forex Market. This is an interesting chapter. This will give you more information rather than theory. Okay, it will give you more information how foreign currency market works. Possibly you may have some interest in the future to work for foreign currency market as an agent. So you can become a financial analyst in foreign currency market. You can trade in foreign currency market. So it will give you a very basic introduction to foreign currency market. There are a lot of things that we must know about foreign exchange market that we do not know because these are not actually covered in other subject areas. So let us know about this thing. What are the things we'll be discussing here, and take this chapter as an informative chapter, information chapter, rather than too much into exams and other thing. Just try to relax and try to learn as much as possible. So in foreign currency market, we'll try to know the functions, their participants, how the transactions are done, what is the market size in different countries, who controls the market, and things like that. Foreign currency quotations, we'll know about quotations, how the foreign currencies are priced. We'll also try to know a little bit about currency derivative market. Derivative market is a very strong market in order to reduce the speculative nature and also to reduce the risk of foreign currencies. We use foreign currency derivative market. Let's look at the first one, foreign exchange market. Look into how the foreign currencies are transacted against each other. In foreign currency market, it means that foreign exchange or foreign currency means the money of a foreign country that is foreign currency bank balances, bank notes, and checks and drafts. So including all the foreign currency reserve in terms of currency bank balances, bank notes, checks, and drafts, whatever is in foreign currency, total value of all those reserves will be called foreign exchange or foreign currency reserve. Now, a foreign exchange transaction is an agreement. Foreign exchange transaction is an agreement between a buyer of a foreign currency and a seller of a foreign currency that a fixed amount of one currency will be delivered for some other currency at a specified time. Okay, so this agreement may not be formal, may not be written, but it can be an informal contract between a buyer of a foreign currency and a seller of a foreign currency for a specific amount to be transacted against each of these currencies' value for within a specific time period. Say, for example, if you later we'll discuss about different types of foreign currency market, but for now, let's say you want to kind of like exchange one Brunei dollar, let's say 100 Brunei dollar to kind of like what Australian dollar. So whatever the currency rate, at this currency rate, you will go to a currency dealer. There are a lot of currency broker house or dealer house available in Brunei. Especially, I know one in Yayasan. I think you have seen that also, currency reserve place in Yayasan. I think every bank in Brunei also has currency exchange house. So you can book an appointment with the bank and purchase foreign currency. when you go and transact for other currency, you are transferring value from Brunei dollar to that foreign currency. So if you are traveling to Australia, for example, you will purchase Australian dollar by exchanging Brunei dollar. This exchange of Brunei dollar with Australian dollar is a foreign currency transaction or foreign exchange transaction. So within very short period of time, possibly 10-15 minutes, a spot transaction happen when you will pay the Brunei dollar to the dealer, and the dealer will give you the Australian dollar and a receipt. This receipt is not a formal part of the transaction, but often the brokerage house or the dealer house will give you a receipt of that state the rate at which the transaction happened and the amount, the total amount, value transferred from one currency to the other currency. Foreign exchange market is the physical and institutional structure through which the money of one country is exchanged for that of another country. So foreign exchange market possibly may not be physical always, but still, since we do not have digital currency yet, we are gradually moving towards digital currencies. So unless we have 100% of digital currency, still the currency market is physical, meaning that you have to go to some place and you have to transfer your value to another currency, and you have to physically carry that currency. That's the only difference between foreign exchange market and other markets. In other markets, you can actually transact online. For example, there are over-the-counter markets where you can basically have online transaction of your shares, your bonds, and other financial assets. Foreign currency market is possibly still the one market where the financial transaction happens physically. You have to be physically there in order to receive your currency in terms of physical form. But you can still carry your credit cards and go to another country and pay, which is a digital currency. But obviously that is costly. You have to pay for it, additional fees and other things. But in terms of not paying anything, if you consider the currency itself, you have to be physically present in a dealer house or a brokerage firm or bank in order to get the foreign exchange reserved or delivered to you or transferred from one currency to another currency. So there are three things here. One is foreign exchange, the other one is foreign exchange transaction, and the third one is foreign exchange market. Look at this two chart. Actually, there are two chart here. First one is this one, and the second one is the lower part, and it is matched, but both the charts are matched based on Greenwich Mean Time, GMT, Greenwich Mean Time. So the first chart shows the global transaction volume in foreign currency market per hour basis. It's a per hour basis transaction value, and we match it conversation of per hour transaction, we match it with trading hours. So this is the trading hours in terms of GMT, and we look at the volume of transaction happening in foreign exchange market. Look at this is GMT, right? So GMT +8, you are in Singapore time frame. So when you are transacting in Singapore time frame, you are also having half of Frankfurt market open, almost half of London market open. You have the entire Bahrain market open during your Singapore time. You also have Hong Kong and Sydney market open during that time, and sorry, Tokyo and Sydney, and also Hong Kong market open during the same time. So a huge international and regional market is open during your time frame in Brunei. So you can actually transact in London, Frankfurt, Singapore, Bahrain, Tokyo, Sydney, and Hong Kong. Most of the Asian markets, Asian and Middle Eastern markets, hello. Can anyone confirm, please? You hear me?
Yes.
Okay. So it will keep disturbing since it's basically using my hotspot, or what do you call it? So don't be distracted. Just take it as a few seconds of break. I'll come back if it is disturbing again. So trading floor, trading hours, and according to GMT time. So if you are transacting foreign currencies in Singapore time, you will get big part of Asian market and also international market, half of international market. So this is your trading volume. You can see that when the Asian market grows, when the Asian market is open from 10 o'clock in the morning, okay, it's basically going up. The transaction volume is going up, and then when the market is gradually, other markets are closing, the volume of transaction is also closing, is reducing. But the highest volume of transaction when is the other markets are open. In the midday of New York, midday of Chicago, and San Francisco. These are US markets. When they're open, the market volume of transaction is the highest. They also match with the London market and also Frankfurt market. So when the London market is gradually closing, the market is also closing. Okay, so the highest volume of transaction is during the day when it is the midday for New York, Chicago, and it is the opening, almost opening for London market. So when the London market opens and New York market midday, that is the time volume of transaction in international market, in foreign currency market, is the highest. Now, that's why I used to be a foreign currency dealer or trader previously. So it was a part-time kind of passion, it was not obviously a job. It was a job once. I used to work in a bank, international bank, very famous bank, but I don't want to tell you the name. So I used to be in their foreign currency department, and I was licensed to trade foreign currencies. So when you guys are sleeping, that was the time the global foreign currency market transactions are happening. So major part of the transaction happens when you haven't yet started your day. But that's why the foreign currency traders, they are actually working at night. So when it is Singapore night, and by the time Singapore midday is the actually working hour of a foreign currency dealer. So some of the time, when I was in Malaysia, my student used to find me even at night. They will WhatsApp me and I will reply them, and they will ask me, what are you doing at night? So basically, I'm trading on foreign currency market. That was the time when market is open, and I will be basically having a very short nap before going to the office in the morning. That is kind of like around 6 o'clock in the morning until 9 o'clock. So most of my classes will be happening in the evening, kind of around like 4:30 onward. So before again the next day, when the markets are opening again in New York, in Chicago, I'll be ready again with my quotations in order to trade in foreign currency market. So you have to match your time. If you are in Asia, you have to match your time with the international market if you want to get the large market. The benefit of getting the larger market is that you get better price. If you go to a better market, bigger market, you'll get a better price because the competition will be high. You'll get a fair price. But if you are in a smaller market, there is a possibility that you might be losing in terms of prices. That's why the foreign currency trading houses, including the banks with their foreign currency divisions, will most probably trade during the night when the Singapore is sleeping. That is the time they are basically awake and trading on other foreign currency markets. Function of the foreign exchange market. What is the function? It is the transfer of purchasing power between countries. So currency exchange or currency value is basically create the transfer of purchasing power. If your currency is strong, your purchasing power is high. If your currency is weak, your purchasing power is low. So currently, for example, if you compare yourself with Malaysian ringgit, your value is 3 Malaysian ringgit to 1 Brunei dollar. In nominal sense, in nominal sense, before considering other factors, your currency is 3 times stronger or 3 values stronger than the Malaysian ringgit. even though it cannot be directly transferred in terms of value of the product and services that you purchase, but in nominal term, in PPP term, they call it, in nominal term, your currency value is 3 times stronger than the Malaysian currency. What are the other functions of foreign currency market? You can obtain or provide credit. Credit means loans. You can go to international market and can ask for loans for supporting your international trade. Remember, that is the part where trade balance is connected to interest rate. So in international market, using foreign currency value, you can have loans given to another company or loans given to another country. You can minimize exposure. If you go to foreign currency market, you can minimize your volatility or exposure to risk of exchange rate. If the exchange rate value is going up or going down too much, you can go to foreign currency market to reduce the exposure, to reduce the volatility of the market. You can deal with foreign currency transactions, instruments. There are different instruments available, insurance instrument available in order to help you to reduce the volatility of foreign currency rate. There are it's a two-tier market. Foreign currency market is a two-tier market, two-step market or two-level market, you call it. The first one is the wholesale market or the interbank market. This is the bigger market where bank-to-bank transaction or dealer-to-dealer transaction happens. So it's a wholesale transaction, massive amount of transfer happens. So it's kind of like, you know, multiples of $1 million of US dollars of transactions happening, or in equivalent size, billions of money transferred a day. I remember still the latest figure was like $3.2 trillion of transaction happens in a nominal exchange globally, foreign exchange transaction, $3.2 trillion. That's a massive transfer, only nominal currency exchange. Okay, so interbank or wholesale market between institutions, and there's a client market. Client market is for consumers like us. If we want to purchase foreign currency, we go to client market. We don't go to the interbank market. We cannot transact in interbank market. Interbank or wholesale market is for bulk purchase. If you are purchasing, for example, $200 million US dollar using Brunei dollar, you will go to the interbank market. You will engage a bank to do the transaction for you. Who are the major participants in foreign currency market? Bank and non-bank foreign exchange dealers. Okay, individuals and firms conducting commercial and investment operation. Speculators and arbitrages. There are some people who wants to go to foreign currency market to speculate, to gain from the differences in the market. So you will speculate, which is not permissible in Islam, but you will speculate on the rates to buy at a low price and speculate that the price will go high so that you can sell at a higher price and make some gain out of it. Also, central bank, and directly and indirectly, they control the foreign currency market, because foreign currency is also measures the stability of your economy. So if the foreign currency is in trouble, your economy is in trouble. Therefore, central bank will try to control the foreign currency market. Okay, I think the next part is a little bit complex in terms of the type of contract or transaction that happens in international market. We'll take a break. Today we'll take a less amount of break because we need to finish some topics. So let's take a break until 10 minutes should be okay, I think. So 9:54 already. We'll come back at 10:05, or let's say 10:10. We'll take 15 minutes, 10:10. We'll come back at 10:10 and we'll continue with transaction in foreign currency market. This is quite interesting. You need to know this thing, how the transaction happen, how the transactions are settled in international market. This will help you to realize that foreign currency market is actually quite interesting market, and many of you might be interested in the future to develop your career around foreign currency market. So I will be going offline time to time, but I'll come back by 10:10. We'll come back at 10:10 in the same channel with the same presentation. I hope everyone is here. Sorry, some internet issue again. Let me share the screen with you. Please, can you anyone confirm whether you can see the screen and can also hear my voice?
Yes.
Okay, everyone. Thank you very much. I had a small meeting with someone on internet, but anyway, we couldn't solve it. But hopefully my phone doesn't die. Okay. We are talking about foreign currency market, the transaction and everything. So now this slide is quite interesting and important for anyone who wants to know how financial transaction happens, how the financial settlement is done in financial market. The descriptions are given in the next page, so you can read the description later, but let me take you through this. So consider this as today. Okay, this is the time period today. Now there are different types of transactions based on time period or based on time of settlement. So if it is a spot transaction, generally when we say spot transaction, we normally mean that it is on the spot. But in financial market, on the spot doesn't mean that it's happening on the same day. Even though transaction happened today, even if it is spot transaction, it will be settled after 2 days. We generally call it T plus 2 days. So transaction will happen today, but settlement will be happening after 2 days. Settlement time is T plus 2 days. So spot transaction happens day after tomorrow, T plus 2 days. Okay, if it is outright overnight, sometimes they call it overnight, tomorrow or next, depending on the spot date and the maturity date. So overnight is transaction happens from today until T plus 2. Overnight, okay? There is a difference between spot and overnight. You can see the date here, okay? And spot transaction happens 2 working days previously. So again, T plus 2 days. So the time period for overnight transaction is 2 days. Time period for spot transaction is also 2 days. Don't forget it. Okay, next is overnight transaction can lead you to number of other transactions. So it can lead you to, for example, a forward contract. Okay, if it is a forward contract, it means it happens forward or in the future to a spot. Okay, for example, if the spot is after 2 days, forward contract will be definitely after the spot. Okay, beyond spot. In general, the definition for forward means anytime in the future. Definitely the time will be settled during the transaction time when the actual settlement happens. And whenever you see the forward contract for a specific time period, obviously you know that it is beyond spot, meaning that it is not going to be settled within 2 days. It's going to be beyond the spot transaction. Outright transaction can also happen in the future, depending on the maturity time. You know, outright transaction can happen within 2 days. Outright transaction can happen also based on specific maturity. Now, but in general, when outright transaction happens based on specific maturity date in the future, it becomes sometime a forward contract. Let me repeat. Let's say you are purchasing $100 million. What is your transaction? Your transaction is you are purchasing 100 million Australian dollar. That's your transaction. Now, if the transaction is a spot transaction, meaning that you're purchasing from the market at spot rate, you know, market rate, the actual settlement, that means actual transfer, will happen within 2 days. If it is a spot transaction, actual settlement will happen within 2 days. If it is an overnight transaction, depending on the maturity, it can happen within 2 days or it can happen beyond 2 days. Now, if it is beyond 2 days, depending on the maturity, the outright transaction can also be a forward contract. Now, what is a forward contract? A forward contract is when this $100 million will be transferred to you after, let's say, 15 days, or let's say after 30 days, okay, sometime in the future. That time period is generally beyond spot. Okay, next is foreign currency transaction overnight can also take place in terms of swap. Okay, now swap is slightly complex. Swap is a derivative financial asset. Swap is a derivative financial asset. In swap transaction, you do not directly transfer currency to currency. Generally, we swap. Okay, swapping means exchange. We swap with two different value. It can be two different currency value in terms of, let's say, $100 million Australian will be swapped against something else, or it can be also in terms of cash flow, swapping cash flow. You can swap your foreign exchange cash flow. For example, it will be very complex for you to understand now. We'll discuss it later, but let me give you an example of swap. In a foreign currency market, instead of buying foreign currency of, let's say, Australian 100 million, what you can do, you can swap your Bruneian dollar with $100 million of Australian. Perfect example is, for example, we purchase from Australia and we also sell to Australia. Let's say we purchase from Australia and we are also selling to Australia. So we have an Australian firm in Australia that is managing our transaction. What they do basically, they produce goods and services, they sell to us, and whatever we produce, we sell to that company to sell in Australian market. So we have both revenue coming from Australian market, and we are also paying Australian supplier. If that is the case, then in order to reduce the volatility and engagement in foreign currency market, what you can do, you can swap your transaction, your cash flow, with your inflows and outflows in Australia. So instead of directly transferring in spot market $100 million Australian to Brunei dollar, and then again using that money to pay the Australian supplier, what you can do, tell the Australian supplier that I have money in Australia, which is $100 million. You don't have to pay me. You just take that $100 million as your payment. So you can swap, exchange for currencies without directly engaging into currency market. So swapping is basically a separate agreement, and generally it happens in the future. It does not happen generally in the spot, even though transaction happen in the spot, but the settlement happens sometime in the future. Swap contract can have an average transaction time of 22 days until I think 90 days time of swapping transaction. So whatever the transaction time period, whatever the average transaction time period, generally swapping transaction happens in the future. So there are at least three transaction settlement time from here. One is the spot transaction. Always remember, spot doesn't mean it's happening on the spot. It may still take some time, and generally it takes T plus 2 days. Another transaction is a forward contract. It means that you may have your actual settlement happening in the future, actual transaction happening in the future. That's called forward transaction. You can also have a swap contract where the actual transaction may happen in terms of exchange, in terms of swapping of cash flows in the future. Swapping doesn't happen in retail market. Swapping is purely a corporate thing. Corporations, big corporations, one another can swap their cash flows in foreign currency because they don't want to transfer from one currency to another currency. Because Coca-Cola, for example, is working in 150 different countries, and they have transaction from 80 different currencies. If that is the case, then it would be too much for them to transact from transfer from one currency to another currency. So instead of doing that, what Coca-Cola can do is they have inflows and outflows in different currencies. They can just swap with the other currencies. So this is the way transaction happens. The details are here. You can read the details later. What is a swap transaction, what is a spot transaction, and others. Another example, another information about swap transaction is swap transaction. As I said, it's mostly institutional. Sometimes the value is so big that individual investor or simple currency trader cannot get into this swap transaction. So the transaction value is so high that companies, in order to engage into a swap transaction, they need a swap dealer. You know, just like a currency dealer, they need a swap dealer. And swap transaction dealer is generally a bank. A bank work as a swap dealer, and international banks earns a lot of money by swapping, by helping companies to swap their cash flows. Okay, by swapping cash flows, you can earn a lot of commission for your bank. So just like an intermediary, you know, in swap market, you need an intermediary, just like a bank. So a bank or financial institution can work as a swap dealer. So company A will go to the bank, and bank will arrange company B for transfer of cash flows or swapping cash flows. And because of doing that service, bank will charge you commission. And if there's any loan involved, bank will also earn interest for the loan. This is the global foreign exchange market turnover. What is the influence of each of these transaction type? For example, the spot transaction from 1989 until 2013, obviously transaction has increased. All types of contract has increased. Previously, spot transaction was mostly the transaction type. Now the swap transaction, you can see FX swap, they call it foreign exchange swap. Swap transaction is the #1 type of transaction that is happening. The outright forwards, forward contracts, these are also increasing in size. Forward contract, the settlement happens in the future, and the others would be option contract and other contracts. These are all derivative contract. We'll discuss about them in the next section. Let's look at the trading center of the world. That's the most important information. You should know why some countries are so powerful financially, even though they are small country, but they are still very powerful financially because of the transaction, global transaction happening in those countries. I'll give you 2 charts and look at these charts very carefully. Look at this information very carefully. Since 1992 until 2013, the influence of United Kingdom, UK, considering London as the center, the UK's financial market has increased significantly. This financial market is not the stock market, is the foreign currency market. That means even though you have transaction in US dollar, later on I'll show you US dollar is the most important currency. Even though the transaction is initially agreed on US dollar, but the actual transaction is happening in the UK. Actual transaction is happening in London financial market. Therefore, London is really important for international foreign exchange market or global foreign exchange market. You can see that the other markets include United States. Globally also, their value is also increasing exponentially. But United Kingdom, having London as the center for global foreign exchange market, controls the majority of the turnover. London, once again, is the most important foreign exchange trading center in the world. Now look at this table. This table gives you the percent of total transaction happens in different currencies. So the currency pair would be USD to Euro, USD to Japanese yen, and others. Okay, so let's look at up until this one, subtotal. Okay, this subtotal. These subtotals are direct engagement of dollar, including also this one, other to dollar. So dollar total, let's look at dollar total. The global transaction happening, where there is dollar involved, US dollar involved. Once again, this is the account of percentage of global transaction happening where dollar is involved. Okay, in 2001, 89.8%, almost 90% of the global transaction, global trade, export and import, whatever happened globally, 89, almost 90% in 2001 included US dollar. Okay, transaction either purchased or sold, a transaction happen using US dollar in the background. In 2013, it has dropped a little bit, but it's still 85%, 86%. 86% of the global transaction, even in 2013-14, involves US dollar. Now you can see why US dollar is so important. However, the major global transaction happens in three currencies. Major global transaction happens in three currency pair: US dollar to euro, US dollar to Japanese yen, and US dollar to British pound sterling. These are the three major currency pair in the world, happening almost 60% of the transaction. 30 plus 20, 50 plus 10, 60.6%. 60.6% of the transaction happening using British pound sterling. So this is a major information for you. You see, euro, if you remember, euro is a major currency, and euro region is a major block, but it's still euro to British pound sterling transaction is only 2.1%, which has reduced to 1.9%. Okay, now you can understand now very easily that why Britain is less interested about being in the European Union. You know, they are still a superpower in foreign exchange market, and the transaction with euro is only 1.9%. So they don't actually care that whether they are in the UK or not. They have better partner. For example, with USD, they have 8.8% of transaction. So they don't need to, as a country, you know, as a country, almost 10% of the global transaction happening in your currency. This is huge. So you don't need to actually have an entire block of euro to be with you. And if Britain is out of the euro region, obviously the dominance of euro will be much lower. So gradually in 2016, 17, or later on in 2021, 22, you'll see that the dominance of euro in terms of global transaction is falling. Is because that other currencies are becoming stronger. So Chinese renminbi possibly is the next big currency that will be coming up, and it will also some major transactions in the world. But if the euro fails, then individual European currencies, including Swiss franc, including Swedish krona, and other currencies in European Union, may come back, you know, to have some, you know, power, currency power in terms of trading relationship. So if euro fails, I heard from one of the lawyer that they were having a discussion, a formal discussion, some economic review kind of thing, that euro may fail, you know, euro may fail within maybe, you know, 3-4 years time, I don't know. So if that happens, then obviously there will be some turmoil in European region in terms of currency value. But obviously, Great Britain pound sterling is still a major currency. Euro is still a major currency, but if euro fails, then obviously the power of GBP, pound sterling, would be much stronger. Okay, now foreign currency quotations. This is also interesting and equally important. You can learn a lot of things from here. There are direct quotations and indirect quotations, and we need to understand these very. These are really important. Otherwise, you will mess up with the quotations later on. So the exchange rate between US dollar and Swiss franc, for example, is normally stated in European terms. Okay, in European terms, the dollar value is represented in $1. Always remember, in European terms, the dollar value, US dollar value, is represented in $1 form, and the Swiss franc is 1.60. Okay, and when it is in terms of USD $1 or any other dollar value, okay, it is the indirect quotation for dollar. Once again, the European terms are indirect quotation for US dollar. and it's a direct quotation for Swiss franc. It's a direct quotation for Swiss franc, and Swiss franc is the home currency. Okay. However, this rate can also be written in American terms. The American terms is where American dollar comes at the beginning, and Swiss franc is represented in terms of one value. So 1 Swiss franc SF is now becomes the indirect quotation for Swiss franc. Indirect quotation for Swiss franc, it's a direct quotation for dollar, and dollar is the home currency, and it is American terms. There are two things we are learning here, four things learning here. What is an European term? What is an American term? What's a direct quote? What's an indirect quote? Okay. Means pricing system. So how the exchange rates are quoted? They can be quoted in European terms. They can be quoted in American terms. Can be quoted in direct quote. Can be quoted in indirect quote. Okay. Most of the transactions globally, you see why Great Britain pound sterling is so important. Why London as a financial center is so important, because excluding two important exceptions, most interbank quotations around the world are stated in European terms. Most interbank transactions are quoted in European terms. However, rates of GBP and euro are quoted in American terms. It must be, because if you cannot quote your local currency if it is in GBP and euro in terms of European terms. So they will be doing in American terms. In America also, most of the transaction will be quoted in European term, not in American term. So it's just opposite. If you come to Europe, it will be quoted in American term. If you go to America, it will be quoted in European term. Okay, let's now go to more examples how the currency point change are calculated. There are two major points, transaction point we identify always. One is a forward quotation, okay, forward quotation, and the other one is a spot quotation. Spot quotations are generally based on market price, spot rate. Okay, spot rate. Spot rate meaning that the outright market price of a currency. For example, if the currency for ringgit and Brunei dollar is 1 Brunei dollar equals 3 Malaysian ringgit, that is the spot rate or the outright market rate for the two currency. Okay. Now, what is a forward quotation? A forward quotation is the price for that specific currency pair for future time. Forward quotation is expressed in points, generally expressed in points, is not a foreign currency exchange rate as such. It is not a foreign currency exchange rate, but it is a quotation system. So a forward quotation is for future, a spot quotation is for current market quotation rate. Now, forward quotation system, that means what would be the rate of a currency in the future is generally represented in terms of a specific expression. For quotation expressed in foreign currency term or indirect quotation, the formula becomes forward quotation F is a function of S minus F divided by F multiplied by the time factor for 360 days divided by N multiplied by 100 is for percentage. So forward quotation, in terms of indirect quotation, the spot rate comes first. Okay, forward quotation for indirect quotation, the spot rate comes first. Forward quotation for direct quotations, the forward rate comes first. Forward minus spot divided by spot. This is usually the case that we use for calculating the forward premium or forward discount in order to calculate the difference between spot rate and forward rate. This is generally the equation that we use. Okay, generally the equation that we use is based on direct quotation. But if it is indirectly quoted, if your currency is quoted based on indirect quotation, you should use this quotation system. Now let me give you an example. let's say you are transacting $100 million again for Brunei currency to Australian dollar, and the currency value is given like this. If one Brunei dollar, for example, is quoted as Australian dollar 1.5. Okay, just an example. It's hypothetical example. If this is the case, now this is Brunei dollar 1, right? So Brunei dollar is the home currency, and this is the indirect quotation for Brunei dollar. Indirect quotation for Brunei dollar, and this is the spot rate. This is the spot transaction, a spot from the market. This is the spot transaction and spot quotation. Let's say there is a forward quotation available. There is a forward quotation available, and the forward rate, depending on whatever the market demand and supply, we found that the forward quotation is 1.7. That means, let's say it's a 3 months forward. I write it this way. It's a 3 months forward, meaning that after 3 months, you can transact, you can buy or sell Australian dollar at 1.7. The current rate is 1.5. Once again, the spot, if you're transacting in spot, the transaction settlement will be 2 days from now. Remember, T plus 2 days. Forward contract will be 3 months. That means it will take 3 months to get your settlement done. Now, after 3 months, what will happen after 3 months? You will be transferred at the rate of 1.7. Now, you can now calculate what is the forward premium. What is the change between the spot rate and the forward rate? You can now calculate what is the difference between the forward rate and the spot rate using one of the equations. Okay, the spot rate is 1.5, the forward rate is 1.7, and if it is direct quotation or indirect quotation, you can calculate what is the forward premium or forward discount. Okay, using the equation. So that's why we have taken this example. You can calculate like 1.7 minus 1.5 divided by 1.5. So forward minus spot divided by spot. You can calculate what is the forward premium or forward discount, whether the forward market rate is higher or forward market rate is lower. You can calculate using this equation. Foreign exchange rates and quotations. Now, in the first class of this section, previous class, I think, I told you that there's an ISO code. There's a 3-letter ISO code that is used instead of traditional symbol. In financial market, in foreign exchange market, they use ISO codes in order to represent currencies. So they don't call it US dollar, they will call it USD. They don't call it Mexican peso or PS, they will call it MXN. This is the official language. When they are quoting, when they are preparing the quotation for buying and selling, they will use ISO codes, the 3-letter ISO codes instead of the traditional symbols. Foreign exchange rates and quotations. This is the repetition or notes on the previous example. So every foreign currency involves 2 currencies, the base or unit currency, C currency 1, and the price or quote currency, that is currency 2. So every currency value that you see, for example, 1 Malaysian or 3 Malaysian ringgit equals 1 Brunei dollar. This currency quotation is basically combination of 2 currency, right? So you get a currency value or currency rate of 2 currencies. One is called the base or unit currency, and the other one is called the price or quoted currency, quote currency. Price or quote currency is the currency 2, and base or unit currency is currency 1. Now, depending on the position of currency 1 and 2, you can consider which one is a direct quotation and which one is a indirect quotation. For example, if it is 1 euro equals USD 1.2174, okay, if it is 1 euro equals USD 1.2174, this is an indirect quotation for euro. This is an indirect quotation for euro. This is a direct quotation for USD. Now, in these currency transactions, you can designate or change which should be your base currency and which should be your price currency. You can put the base currency first. You can also put the price currency first, alternatively, depending on which quotation system you follow. If you follow the indirect quotation system, generally you'll follow this. USD 1.2174 equals Euro 1. This is the indirect quotation system or Euro. And in most of the cases, you'll see currency values are placed like this. So these are conventions, these are practices in foreign currency market. Nowadays, due to use of technology, this quotation system is very easy to understand. And even if you make any mistake on the software, it will correct it yourself. It will correct itself, so they understand what is the direct quotation and indirect quotations of each currency. This is an example of foreign currency quotation. An extension of foreign currency quotation is given in terms of the European terms and also in terms of the American terms. In the European terms, foreign currency price of $1. Okay, $1. And in American terms, US dollar price in €1. They considered euro as the foreign currency here. So in American terms, the foreign currency will be in terms of 1 unit. And in European terms, US dollar will be in 1 unit. In European term, the US dollar will be in direct quotation. In American terms, the foreign currency will be in indirect quotations. You can look at it. USD $1 equals Euro 0.8214. Okay, this currency relationship can also be represented into this form. USD to Euro ratio is 0.8217. Meaning that 1 USD equals Euro 0.8217. The opposite is also true if you want to represent in terms of American rate, American terms. Euro 1 would be just the opposite of 0.814, which would be USD 1.2174. So it's just a dividation. You can divide 1 with 0.82. Let me calculate this for you. Yes, so basically, if you consider this currency value, so this is given here actually. If you divide 1 with this value, Euro 0.82174 or 8214, it will give you the indirect quotation for the foreign currency. So USD 1.2714 is 1 euro. So 1 euro is indirect quotation for euro, and USD 1.2714 is the direct quotation for USD. So try to remember 4 things: European terms, American terms, indirect quotation, direct quotation. Also, there is a difference between spot rate and forward rate. Forward rate is can be higher or lower than the spot rate. If the forward rate is higher, there might be a premium, and if the forward rate is lower, there might be a discount. So forward rate can be a higher premium or can be lower, a discounted forward rate. And this is a quotation system in international market. The spot transaction and forward quotation for the euro and yen. Yen is Japanese currency, euro is the euro region currency, and this table is also quite interesting. It will give you a lot of information. Let me give you the information here. First one is, let's look into the euro side, euro spot and forward rates. This is in terms of dollar to euro. Dollar to euro. Okay, be very careful about it. And there are 2 rates given here. One is the bid price, one is the ask price. Okay, the bid price is the purchase price, bid is the purchase price. Okay, ask price is selling price. Ask price is the selling price, bid is the purchase price. And these are purchase and selling price of financial institutions. These are purchase price and selling price of financial institutions. What are the terms given? Spot term. In the spot market, the rate is $1.0897 to 1 euro. And the selling price is 1.0901. So selling price is higher than the purchase price. That's the spread. The difference between selling price and the purchase price is the spread or return. Now, spot transaction, remember it will happen in 2 days, T plus 2 days settlement. And then you have other cash rates, cash transactions, settlement in 1 week, cash rate settlement in 1 month, cash rate settlement in 9 months, cash rate settlement in 1 year. Still cash rate settlement, but in future contract rate, forward contract rate. Now, if you have a forward cash rate, rates are given. For example, for 1 week transaction, it's a 3-point difference from the spot. 3-point difference plus from the spot. If it is a 1 year contract, it's a 242 point extra from the spot. Okay, let me now show you how it is calculated. 3-point extra means 1.0897 plus 3 is 1.0900. Okay, now let's say we see another one. Let's say this 90 points. After 5 months, the forward rate will be 90 points plus, all plus here, 90 points plus, then the spot rate. If the spot rate is 1.087, the forward rate will be plus 90. Okay, plus 90. But there is an issue here. What is the issue here? You can compare a little bit. Here we have 4 decimal point. 1.0000, 4 decimal point. We have 2 decimal point here in Japanese yen. Okay, so need to be very careful. Remember in the first class I told you some currencies will be represented in 4 decimal point, some currencies will be represented in 2 decimal point. Even though nowadays they are standardizing it, they are representing most of the currencies in 4 decimal point. But in case if it is 2 decimal point and 4 decimal point, how do you differentiate the spot rate and the forward rate? So in terms of the 4 decimal point, let's look at the 4 decimal point first and look at the first example again, how they are calculating it. 1.0897 plus 3 point. Okay, so 0897, right? So if you add plus 3, so you are basically adding 0.0003. Okay, 0.0003. So if you are adding 3.897 plus 3 should be 1.0900. So 897 plus 0.0003. Okay, so this 3 in terms of 4 decimal point is actually 0.0003. If you add this with 0.0897, 0.0897, just add it, you'll get the forward rate. The forward rate would be 0.0900. So this is the forward rate that you get. So how do you add? What is the 3 point means? The 3 point for 4 decimal point means that is the last digit. Is the last digit. Now look at this one. 242. What is the 242 point means here? It means 0.0242. Okay, so you have to match the 4 decimal point. And if you add this, it will be 1.1139. Okay, add with the spot rate. Similarly, you can do it for ask rate. Ask price is the selling price. Similar methodology. Just need to be careful that it is 4 decimal point or 3 decimal point. Look at another interesting side is apart from cash rate, there are also swap rates given. Remember the swap transaction in the future. Swap rate can happen for 2 years in the future, swap rate for 3 years in the future, swap rate for 4 years in the future, and 5 years in the future. Swap rates can, since there is a bank involved in swap transaction, you can take risk for future transaction as well. And from the spot rate, swap rate for 5 years, for example, will be higher by 1129. Okay, I think you can hear me again. Let me know if you don't hear me. So how do you write this? 1129 is 0.1129. So we'll add this entire thing with 4 decimal point of spot rate. Okay, so this is the way 4 decimal point and 2 decimal points are differentiated in foreign currency transactions. Now come to 2 decimal point. Let's take some example. Again, for Japanese yen, we have a bid price, which is the purchase rate, which is ask price, which is the selling rate. Selling rate should be higher than the purchase price in order to make some gain. So now the spot rate is 118.27 and the ask price is 118.37. Okay, now the cash rate for futures will be different by points. Now the let's say 1 week future rate, cash rate is minus by 10 points, lower by 10 points. So 118.27 minus 10 should be 118.17. So here this minus 10 is written as in 2 decimal points. So it's just 0.10 and it's a minus sign. So 0.27 minus 0.10 is 0.17. Similarly, if you have 2592 minus 2592 minus, so the future rate for 5 years swap rate will be calculated by 118.27 minus 25.92. This one would be written as minus 25.92. Okay, minus 25.92. So if 25.92 minus, it becomes 118.27 minus 25.92 is 92.35. Now what is the difference here? What is the complexity here? If you do not understand the difference between 4 decimal point and 2 decimal point, instead of writing minus 25.92, you'll write minus 0.2592. If you write 0.2592, the entire value will be different. That's why understanding the 4 point and 2 decimal points are important. So we have seen the spot rate and future rate, the forward contract rates for 2 different currencies, and we have seen there are 2 different prices, bid price and the ask price, for number of transactions involving spot rate, cash rates in the future, and swap rates. And what we learned from here, number 1, the ask rate will be higher than the bid price because selling price will be higher than the purchase price. Second thing we learn here is some currencies follow 4 decimal point, some currencies follow 2 decimal point. Third thing we have learned here is that the forward contract rate can be higher than the spot or can be lower than the spot depending on the demand and supply of that currency. If that currency is good currency, the currency that you are transacting against is a good currency, the forward rate might be higher. If the currency is generally losing value, the currency may show, forward rate may show a negative value. So whatever the negative value or positive value, we need to identify what is the 2 decimal or 4 decimal point, calculate what is the forward rate based on the points given. So in the financial market, you will not be given with the forward rate. You will not be given with the forward rate itself. You will be given with the spot rate and you will be given with points. Spot rate and points, forward points. You need to calculate what is the forward rate based on the rate, spot rate, and the forward points. Okay. Next part is foreign currency derivative. This is a little bit complex for many students, finance students especially. I will go very slow. Okay, we'll have around 30-35 minutes. Hopefully we can finish. If not, then we'll continue in the next class. Don't worry about it. Foreign currency derivative. Now, first of all, what is a derivative contract? What is a derivative contract? What do you mean by derivative? The dictionary meaning of derivative is that one asset depends on another asset. One thing depends on another thing. Or one asset created out of another asset is called a derivative asset. Okay? For example, one business created out of another business, the second business would be called a derivative business. Okay, say for example, you had a car workshop. Okay, you had a car workshop. Now you started another business, which is a cafeteria. Cafeteria in the car workshop. So the customer, those are coming to your car workshop, they will have to wait for 30-40 minutes for the car to be fixed. So during that time, they will have cafe, they will have coffee, they will have snacks, they will have food. That restaurant business or cafe business is depending on your business of tire shop or workshop. So the second one, the cafe shop, is a derivative of the first one. So the value of the cafe shop, therefore, the value of the cafe shop will depend on your business of the workshop. If your car workshop is doing good, many customers coming in, automatically your cafe business will be good. But if your car workshop is down, customers are not coming during lockdown, holidays, or whatever is the problem, your cafeteria business will be automatically down. So in derivative also, derivative means financial, it's a financial asset that is derived, that is created from another asset. Okay. Currency derivative is obviously a financial asset that is created out of another currency. Okay, currency derivative is a financial asset that is created out of another currency. Okay, we'll give you a lot of example how currency derivative works, what is the purpose and things. Let me show you some data. This is the US financial assets as a percentage of GDP. US financial asset as a percentage of GDP. You see the growth of US financial market, you know, until 2007 and 8. In 2007 and 8 financial crisis, everything dropped. So there was an exponential growth in US financial market. Instead of growth at this rate, they have grown actually exponentially. And this is the credit default swap market. Credit is basically a kind of a loan default swap. So it's a swap market. Let's say it's a swap market. It's a derivative market. This is the growth of US derivative market until 2008 financial crisis. This was also growing at an exponential rate. Okay, so derivative market has been fueled in the US or all over the world depending on the growth of actual financial market. So derivative market is derived, the value of the derivative market is derived from the value of financial market. If the financial market is good, derivative market will be automatically good. If the financial market is down, derivative market will be automatically down. It's just like your car workshop and cafeteria example. What are the major benefits? It permits the derivative contracts or market, it permits firms to achieve payoffs or benefit that would not be able to achieve, that the company will not be able to achieve without derivatives, or could achieve only at a greater cost. So let's say you want to increase your total monthly income. So apart from your car workshop, you have also increased another business. You have started a new business, which is a cafeteria. So you could have been achieving similar salary or similar income without having the restaurant, but you should have been also investing a lot of money with the car workshop. So you could have achieved the similar benefit, but at a higher cost. But derivative is the financial asset that helps you achieve higher payoff, higher benefits. Okay, that would have been usually not possible without the use of derivative. But the primary purpose of derivative is to hedge, is to protect you from risk. The primary purpose of derivative is to protect you from risk. So derivative risk management contracts. Derivative contracts are generally used to reduce the risk from currency market change. 4 major types of derivative contracts available. One is the option contract, second is the futures, third is the forward contract, and then the swap contract. There are 4 contracts available, and futures and forward contracts are almost the same. We'll discuss it in a short while. Option contract is also a little bit unique, and swap contract is unique too. Currency option contract. Okay, always remember, this is your restaurant business, and the cafe business or restaurant business is separate from your workshop. Okay, so the currency option contract or derivative contract is a separate contract. It's a separate financial asset than your actual currency. So there are 2 things you are dealing with. One is your car workshop, and another one is your cafeteria. In terms of currency derivative contract, you have 2 things. One is your currency itself, and the other one is your currency derivative contract. So 2 different things. Currency option contract is foreign currency option is a contract, it's an agreement giving the option purchaser, whoever purchased the option, whoever purchased the derivative contract, whoever is the holder of the derivative contract, it gives the purchaser the right. It's a right. Okay, it's a claim, it's a right, it's an authority, but not the obligation. Okay, be careful. It's an option. Option means you have the right. Okay, but not the obligation. You are not obliged to do that, but you have the right to do it. You have the right to buy or sell a given amount of foreign exchange, given amount of foreign currency at a fixed price per unit for a specific time in the future. Okay, for a specific time or at a specific time in the future. So first thing first, from the very end, option contract or derivative contract is a forward contract. It's a futuristic contract. It's a contract that has settlement in the future. Option contract does not happen in spot. Okay, it's a futuristic contract. So the settlement will happen in a future date, and that future date must be specified. It must be specified, and that future date is also called the maturity date. So every derivative contract will have a maturity date. That maturity date is beyond spot. Okay, it's not a spot contract. It's a futuristic contract. This is number 1. Number 2 is unique to option contract. Option contract gives you the right. Okay, it's very important. Option contract gives you the right to buy or sell a given amount of foreign exchange, a given amount of foreign currency. For example, if you buy an option contract, you have the right to buy. You have the right to buy Australian dollar 100 million. This is our example. Australian dollar 100 million. You have the right to buy Australian dollar 100 million after 1 month. After 1 month. This is the maturity date. After 1 month, you can buy Australian dollar 100 million. At what rate? There is a rate given. What is the rate? The rate is you can buy this at Brunei dollar 1.5. For example, Brunei dollar 1.5. At this rate, you'd be able to purchase Australian dollar 100 million in 1 month time. So this is a right given to you. This is a right given to you that you can exercise this right. You can use this agreement to purchase Australian dollar for any purpose in the future by 1 month, and the rate at which you can exercise this contract is 1.5 Brunei dollar 1.5. So this is the fixed rate. This is the fixed price per unit. Now, how this can help you in risk management? By fixing the rate for 1 month using this agreement. Whatever happens to Australian dollar within this month, you would be able to still buy the Australian dollar at Brunei dollar 1.5. 1 Australian dollar equals Brunei dollar 1.5. Whatever happens to the market, by using this contract, if you want to, you can buy Australian dollar at 1.5 Brunei dollar per Australian dollar. If you do not have this contract, if anything happens to Brunei dollar and Australian dollar rate, you may make a loss. Okay, if you are purchasing Australian dollar in the future, and if you do not have this contract, you may make a loss because of the changes in exchange rate in the market. Therefore, this option contract will give you the right to benefit by fixing the price in the market for future time period. There are two basic types of options. One is called a put option and the other one is a call option. Okay, one is a call option rate, one is a call option contract, the other one is a put option contract. A call option is a right to buy. Okay, call connected to buy. A put option is a right to sell. So if you're buying a put option, you do not have a right to buy foreign currency. If you buy a put option, you only have the right to sell a specific foreign currency after certain time period or on or before certain time period at a specific rate. Okay, so the call option connected to purchase, put option connected to sell. There are a few other elements that we need to know. There is an exercise price or strike price. What is an exercise price? This is the price at which you will exercise, you will use the foreign currency option contract. This is the exercise price generally written on the contract, that this is the exercise price or the contract price at which you will use the contract. You will exercise the contract. Now here the exercise price is given Brunei dollar 1.5 to 1 Australian dollar is the exercise price of the contract. This is the strike price of the contract. Now it can be also different from this currency rate. Okay, it can be also different from currency rate depending on premium and discount. So the premium, what is the premium? Every contract has a price. When you're buying this option contract has a price because it is giving you a specific benefit. When you get a specific benefit from a contract, you have to pay a price. Premium is the price of the contract. Premium is the price of either call or put option. So if they call it a call premium, meaning that this is the price of the call option. If they call it a put premium, this is the cost of the put option. The premium is the cost, price, or value of the option itself. Okay, this is the cost or price or value of the option contract only. Okay, the underlying price, underlying asset, the underlying or actual spot exchange rate in the market. So you need to also compare. In order to compare whether you should exercise or not, you need to compare with the actual spot rate. Well, obviously, let me give you an example. If you want to buy foreign currency and you purchase a call option, because buying is connected to call option, and you definitely want to buy at a low price. Okay, anything you buy in your life, you want to buy at low price. So if you have a call option that has a contract value of, let's say, $1 or $1.5, In the future, you will only exercise the contract. You will only exercise the contract if the contract is beneficial for you. If you see that the contract price, the actual market price is already low, if you see that actual market price is already low compared to the contract price, you will not exercise the contract because you don't need to. The real market price is already low. You don't need to use the contract. But then the question is, why did I use the contract? Why did I purchase the contract? Because the contract gave you the security. Contract gave you the safety. If the price is somehow high, very high, then you can use the contract to get a lower price. But if the actual market price is already low, you don't need to exercise the contract. That is what is said here, that it is a right. You can exercise it, but not an obligation. You may not exercise it if you find it less beneficial. Okay, so if you find that the real market price is actually low, you don't need to use the contract. You can directly go to the market and purchase at a low price. But the problem is, even if you do not exercise, the cost of the contract or the premium must be paid. Even if you do not exercise, the cost must be paid. Okay, we'll give more examples in the next chapter when we do currency risk management. Okay, in currency option contracts, some other terms that you need to know. An American option is maturity date on or before. An American option is when the maturity or transaction can be executed on or before the actual maturity date. Let's say the actual maturity date is 15th of October. So if it is an American option, you can exercise it on 15th of October or before 15th of October. So after 15th of October, the contract is automatically void. In an European option, European contract, on expiration, not before. On expiration date, on the maturity date, not before. So you cannot transact before the maturity date. You can only execute the contract on the maturity date. These are the difference between the American option and the European option. We have already told you the premium is the option price of the cost of the option. The buyer is the holder, seller is the writer. Okay, buyer of the option contract is called the holder of option contract. Okay, and the profit or payoff for buyer and the seller will be opposite. We'll show you when we do it. Okay, and the option whose exercise price is the same as the spot price, we call it at the money. There are different terms they use. Okay, different terms. If the exercise price and the spot price are same, we call it at the money. An option, it would be profitable, excluding the cost of premium if exercised immediately, is said to be in the money. If the option contract is beneficial to you, in the market, sometimes they call it in the money. So the moment you hear the term in the money, meaning that this option contract was profitable to you and you exercise the contract. Okay, and there might be also out of the money. Out of the money is an option contract that would not be profitable, again excluding the cost of the premium, if exercised immediately. So the moment you hear the term out of the money, meaning that it's not profitable, after considering the cost and other aspect, maybe the cost is high, so it's not going to be profitable. OTC market, over-the-counter market, deals are customized, whereas the organized market deals are standardized. So there are two markets. OTC market, you can get customized quotation. You can get customized quotation for the specific currency that you want to buy. Okay, but standardized market deals, standardized or organized market deals are standard. You cannot customize them. You have to match your requirement based on the market deals. For example, you want to buy 100 million Australian dollar, right? If you remember, 100 million Australian dollar, if you go to OTC market, you can customize it. Okay, you can buy in 2 sets, $50 million, $50 million. Okay, you can customize it. But in a standard market, organized market, you will have to match who is selling $100 million. Okay, organized market deals are not customized for you. You have to match yourself. You have to match your requirement with the deals available in standard market, in organized market. So sometimes in organized market, you may not have a deal that is selling $100 million. Okay, remember you purchased a call option for $100 million Australian dollar. So if you go to organized market, you may not get exactly someone selling $100 million. So what you have to do? You have to adjust. You have to change. You may have to buy more. You may have to buy less. Okay. When you buy more or less, there are costs involved. Okay. So you have to be careful whether you are going to OTC market or organized market. There are problems as well. Since OTC market help you to customize, they charge you more. The premium in OTC market is higher. Premium in organized market, since it does not allow you to customize, organized market premiums are low. So the cost is low as well. The benefit is high in OTC market, premium is also high. Organized market benefit is low, premium is also low. Swiss franc option contract quotations. This is an example of Swiss franc option contract for US cents to Swiss franc. These are underlying option values. First one, option and underlying values. This is in terms of cent. So 58.51 cent. Okay, to Swiss franc. 1 Swiss franc is 58.51 cent. So this is the option contract value. Now strike price at which you can purchase contract. There are different strike price available. 56 strike price, it's a contract. Each of these are contract basically. And the expiration date is available, call option. Last expiration date available, December. Okay, you do not have any expiration in maturity in August. There is no contract. There is no contract for expiration in September. So even if you have a transaction settlement in September, you cannot buy the first contract. Okay, the first contract, call option only available for December. Put option, right to sell if you are selling. Okay, the put premium, these are the premium, the discount and premium. So at put premium of 0.04, settlement available in September, August, September, and also in December. December put premium is 1.16. Okay, that means the cost of the premium, the contract is 1.16. Let's take the last one. 58.51 is the option underlying, 58.51 cent. The strike price is 60 at this value. The contract is not available in August. There is a contract available in September. You can buy it. Premium is 0.31. There is no contract available in December. If you are selling, there is a contract available in August, 2.32. There is a contract available in September, 2.62. There is a contract available in December, 3.30. Okay, so you need to match when is your expiration time, when is your maturity time, and what is the premium available. Okay, based on the premium and the exercise price or strike price, you will make the decision whether you are going to exercise the contract or not. Okay, there is also a limitation here. Each option contract is 62,500 Swiss franc. Okay, so minimum transaction is for 62,500 Swiss franc. Minimum transaction. So if you are buying or selling lesser than this or more than this, more you can do, more you can adjust. But if you are buying lesser than this, let's say you are buying 50,000 Swiss franc, you cannot buy a contract. You have to buy minimum of 62,500 Swiss franc. If you need a customized contract, you'll go to OTC. These are standard market rates. Okay, I believe you can hear me again, internet issue. So once again, if you go to, this is a standard market rate. If you go to OTC market, the premium rates would be slightly different, slightly higher or lower. Okay, this is the call option profit and loss. I will teach this in the next class, in the risk management class, not here. You will not understand it now. Let us have the overview of all the financial asset first. So this is a little bit complex right now for you to understand. I will also upload some explanation for this. You need to go through this because derivative market is not very easygoing subject. You know, it's kind of very, they call it, you know, hybrid market. So these are exotic financial assets. These are kind of like sometimes very difficult to understand. Anyway, I will touch it again in the risk management chapter. This will be more applicable to our risk management chapter. So we'll consider it then. These slides I will use with other examples. Okay, now currency futures and forward markets. Now, as I told you just now, that these two markets are almost similar, currency futures and forward markets. The only difference is both these contracts are happening in the future, just like option contract, right? It's happening in the future time. But even if it is happening in the future time, there is a slight difference between futures market and forward market. The major difference is here. The currency future market is standardized. Okay, it's a standard market. It's a standard market. And the forward contract is any size desired, meaning that you can customize it. So once again, forward market, it's a customizable contract. And the futures market, the futures market is standard market. It is not customizable. So once again, forward market is customizable. Futures market is not customizable. This is the standard market. You need to match yourself. You need to match yourself with the standard market offering. In forward market, you can negotiate to create your own contract. In futures market, you cannot negotiate. You have to match yourself with the standard market rates. You know, it's like when you go to a restaurant, sometimes there are set menu, right? Set menu. So in set menu, price is already set. There is no chance of customization often. You can customize, you can add more things, okay? But the cost is same, or you need to add additional cost. But if you're not having the set menu, you can do a la carte, right? So you can add up things. That is the forward contract. And a la carte obviously is expensive, is more expensive than the future contract. So forward contract more expensive than the futures contract because futures contract cannot be customized. Forward contract can be customized. The other things are all almost the same, You know, just that difference in settlement time and, you know, pricing process. You know, look at the pricing. open outcry process because it's a standard market. You can openly shout for pricing on the exchange floor. Okay, and prices are determined by bid and ask quotes. More customization is possible in forward market, but in futures market, exchange floor standard quotation system will determine what should be the price. Therefore, there is a difference in pricing mechanism. Location, trading occurs on an organized exchange and trading occurs between individuals and banks. So customization is possible because trading is happening between individual companies and banks. Read the other differences. If you have questions, you can raise it to me later. Okay, this is an example of, once again, we will not touch the example right now. This is similar to the option contract. This is an example of interest rate future strategies for common exposure. So how do you basically use the future contract? And it involves interest rate. It involves currency rate as well. We will not use it right now. We'll use it later when we give example on risk management. Last one is interest rate swap. Interest rate swap, we will give you basic information, not the details, not the detail of the strategies for now. Strategy, we'll do it later. Based on the swap contract, what is a swap? Swap is a contractual agreement to exchange or swap a series of cash flow. So you have cash flows in two different currencies. You can have a contract with another party in order to exchange your cash flows in that currency. These cash flows are most commonly the interest payments associated with debt service, such as the floating rate loan or any other payments that you have. You may have other payments connected to, for example, cash flows associated to your export, cash flows associated with your import. You can kind of like swap these cash flows with different other companies. If the agreement is for one party to swap its fixed interest rate payments for the floating interest rate payments of another, it is termed as interest rate swap. So there can be interest rate swap for swapping cash flows related to bank loan. You can also have swap for currency swap. What is a currency swap? When the cash flow is connected to currency value. If the agreement is to swap currencies of debt service obligation, it is termed as currency swap. You can actually combine both. If you have both currency swap in different interest rate, or you have interest rate swap in different currencies, you can actually combine both interest rate swap and currency swap. A single swap may combine elements of both interest rate and currency swap. So the more combination you do, it will be more complex to understand for normal investors. And generally in swap market, there is a dealer that helps you to swap between two different parties. For example, you have company A wants to swap some cash flow with company B. They often do not do it directly because finding the counterparty is very tough. So company A and B, without directly dealing with each other, they will have a currency dealer or swap dealer in between, just like a bank. So A will deal with the bank, and then the bank will deal with the B. Okay, so it's like a intermediation that they create. And currency swap, again, there is a premium. There is a cost of currency swap. The swap spread, they call it spread, swap spread. And this is basically determined based on the relationship between A and the bank and the B. So bank actually earns swap spread from both the parties because these are two separate transactions. One is kind of like a deposit transaction. One is a loan transaction. So basically the bank is dealing with both parties separately. Therefore, bank has a big business in swap. The moment swap transaction happens, bank can earn both interest rate because it can be a loan, and bank can also do swap spread for transaction settlement for both the parties. I'm not sure whether it is written here. One of the major challenge in a swap contract is still a major challenge in a swap contract is that, as you can see from A and B, a swap contract requires three parties, party A, party B, and a swap dealer. Also, there is another party involved is the swap exchange, the swap market, swap market. So if we consider that swap market is already there, at least three parties needed. Two parties, those are swapping with each other, and there is a swap dealer in between. Sometimes it is very difficult to find the counterparty. Counterparty means party A wants to swap something, but the bank is not getting any party B. So if that is the case, then there might be some problem. The problem is bank then has to increase. Bank will increase the swap commission, swap spread. Bank will increase because banks will say that I'm taking too much of risk for you because there is no counterparty available. So I will increase the swap premium, in order to find the counterparty for you. It's just like for example, you are selling a car and there is no buyer for the car. So the broker, the second-hand car dealer who you are selling your car to, if they cannot buy a buyer, they will normally discount the price. They will say, well, I need to keep the car for a long period of time, so I'm not getting a purchaser of your car, so I will not give you the price that you're looking for. The price will be lower and you will have to accept it because there is no counterparty, right? So in a swap contract, counterparty risk is a major risk. That risk can be reduced by obviously involving with a bank. We'll stop it here today. We'll stop it here. So what we have done so far today, we have taken a deeper look into foreign currency market. We have talked about foreign currency parties, transaction, market turnover in different parts of the world. And then we have talked about quotation system, how the pricing is done, what is the difference between spot rate, forward rate, swap rate, and also forward and future market rates. Then we move to the derivative contracts. We have talked about at least 4 major derivative contracts, the call option, option contract, and then we talked about futures and forward, and then swap market. So in the future, we'll show you how to use these derivative market in order to secure your cash flows, in order to reduce the risk of international investment. So we'll stop it here today. Go through these descriptions or information that we have shared with you. And if you have any question, you can ask me later. In the next class, I think we have a small discussion on foreign currency rate. After that, I think we'll move to the risk management part. All the best until the next class. Again, stay safe. Brunei is still not safe, and try to be with your family members and friends. Thank you very much. If you have any question or queries, let me know. Also, give me an update on Canvas. Give me an update on your assignment. It's very important. Your assignment is very important. Give me an update later. Thank you all very much. Okay, Assalamu alaikum wa rahmatullah.